28% gone in 2 days. And the crazy part, the earnings were fine. What's up, guys? Coach B here. All right, I'm making this video because what happened to Supermicro on June 9th and 10th is one of those situations that trips a lot of people up. The company is doing well. They've got a nearly $40 billion AI server order backlog. Business is booming, and the stock got crushed. So today I want to explain exactly why, because this mechanic comes up over and over in the market, and if you don't understand it, it will absolutely catch you off guard. Let me set the scene first. Supermicro, ticker SMCI, fell just under 28% across 2 sessions, June 9th and June 10th. The stock dropped roughly $11.37 over those 2 days to close around $29.27. Volume spiked to nearly 4 times its 3-month average, almost 400% of a normal day. That is not a normal day. And again, not because of earnings, not because they missed a number. The trigger was a financing announcement. Supermicro announced they were raising roughly $7 billion through new stock and equity-linked instruments. The goal was to fund that AI server backlog. Makes total strategic sense, but here's where traders start to feel that sick feeling. The stock you own just got cut into a lot more pieces. This is what dilution looks like. When a company issues a big slug of new shares, every existing share now represents a smaller ownership percentage of that company. You didn't change anything, but your piece of the pie just got smaller, and the market prices that in immediately. Let me walk through the math so this is concrete. Say a company is worth $100 total, and right now there are 10 shares outstanding. Each share is worth $10. Now the company issues 4 new shares. Same company, same assets, but now there are 14 shares. If the valuation doesn't jump 40% instantly to match, each share is worth less. That is dilution. It is mechanical, it is automatic, and it is why the market sold off hard, even though the order backlog is real and the business is growing. This is the part that really trips people up. You can be completely right about a company's fundamentals and still take a painful loss in the short term. That's what makes dilution so dangerous as a catalyst. The business did not deteriorate during those 2 sessions. Supermicro still has that AI backlog, but existing shareholders immediately own a smaller slice of it. The market's job is to reprice that instantly, and here's the downside scenario that is very easy to construct. If you own Supermicro going into that day, say you bought at $40 a share, comfortable with the AI thesis, you watched your position drop nearly 28% across those 2 days. That is not a small paper loss. On 100 shares, that is roughly $1,100 gone over the 2 sessions. The trade you made was based on the business. The loss came from the cap structure. All right. So how do you think about this going forward? You can't always predict when a company will announce a raise, but there are signals. When a company is growing fast and spending heavy, AI infrastructure build-outs, massive order backlogs, aggressive expansion, they need capital. Watch for SEC filings, shelf registrations, and any language in earnings calls about funding growth. Those are the flags that say a dilutive raise could be coming. The long-run question is whether the capital they raise generates enough return to justify the dilution. That is a legitimate thesis. Some companies raise money, deploy it well, and the stock more than recovers. Others do it repeatedly and the stock just grinds lower. That is the analysis you do before you decide whether you'd want to be in the stock after the drop. The bigger takeaway here is about understanding what actually drove a move. When SMCI dropped 28% across those 2 sessions, some people sold in panic thinking something was fundamentally broken. Something changed, but it was the capital structure, not the business. Other people started asking whether the new lower price after the dilution was actually a better entry if you believe in the AI server thesis. Those are 2 completely different responses, and which one you have depends entirely on whether you understood the catalyst. I'm not telling you what SMCI does from here. Make sure you re-verify the close and any updates the day you're watching this. These things move, but the mechanic is real, and it is going to show up on the next fast-growing company that needs to fund a big order book. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. So that is the Supermicro story. The company is not broken. The order book is real, but a nearly $7 billion equity raise on a stock that was already pricing in a lot of growth is going to hit existing shareholders hard, fast, and mechanically. That is how markets work. And now you know the playbook when you see it next time. If this one clicked for you, hit that like and subscribe. Drop a comment with what you want me to break down next. Good luck in the markets, no matter what stock you're into.